In this video, we're going to continue talking about bond valuation, some of the calculations that are involved with determining yields, etc. We'll also talk a little bit about ratings and how bonds ultimately, how we view default risk later on in the video. So let's think about a callable bond and what's referred to as the yield to call. So the definition, yield to call, very similar to yield to maturity. This is the rate of return you would earn if you bought today and the bond was actually called on the first day at the end of any deferred call. So we have a 10% semi-annual coupon bond. It's 10 years. 11.3590 is the price. It has an 8% yield to maturity, and it can be called after 5 years for $1,050. So how do we incorporate that mathematically? Well, there is a section in this bond valuation and duration worksheet. There are two cells, one for the call premium and one for the years to call. Obviously fill them in appropriately, and now we end up with a yield to call over here of 7.53%. Now notice that we have made a little bit of a change. That is, we've changed the compounding frequency from 1 to 2 because this is a semi-annual bond. Doing that, obviously we have a yield to maturity of 8%, and we have the yield to call at 7.53%. So without thinking too much more, right, which would you more likely want to do? Would you be hopeful that the bond would be called, or would you want it to last to maturity? So in general, if bonds are selling at a premium, the coupon is greater than the yield, so a call is likely. So what do you expect to earn? The yield to call is what you expect to earn on premium bonds. The yield to maturity on the par and discount bonds. So essentially, what does this mean? Well, if the bond is selling at a premium, that means that interest rates have fallen and prices have gone up. If interest rates have fallen far enough, it is now economical. In fact, it's cost savings for companies to try to call, if possible, to refinance. The next question we have is about sinking funds, right? And this calculating what the sinking fund requirement would be is a simple time value annuity question, right? So if you wanted to pay off this debt with equal payments for the life of the bond, how much would you be willing to pay per year? So let's assume we have $150 million. It's a 30-year bond. It was issued when interest rates were 7%. So how much must you pay per year to pay off this debt? So solving for the payment, then, obviously we need to use the time value of money worksheet. So here we have $155 million is the future value, interest rate 7%, time and value is 30 years. And if you look down here, the payment is $1,587,960 and some pennies. So again, every year you would make this payment into some type of an account. So how do we do that? So to utilize this sinking fund, if the value of the debt is greater than $1,000, we would let the sinking fund sit there in this account and earn interest. Think about it. Why would you want to pay off $1,000 debt with $1,200? And the answer is you wouldn't. But if the debt was currently, you could buy the debt yourself for $800 and reduce $1,000 of debt from your financial statement. Paying $800 to get rid of $1,000 makes some sense. So if the value of the debt's less than 1,000, you would just go to the market and buy that debt back. So how would this ultimately work? It's just a very simple question. On the day to make a payment, you look at the value, right? It's either going to be kept and earn interest until a later date. If the interest, if it was always greater than $1,000 for its entire life, theoretically at the end, we'd have $150 million in this account. Now, that's not going to happen throughout the entire life of the bond. It's going to go above and beyond that premium value of $1,000. It's going to go above that. It's going to go below that. So we will make our choices dependent on whatever the market value is at that time. So hopefully that makes a little bit of understanding. So you can, obviously the investors want to be sure we're going to have the money available, right? And as I mentioned in a previous video, it's unlikely that a company is going to store this money and then 30 years from now have $150 million sitting in this account so they can just pay off this debt all at once. They want to pay it off over time, typically. If they don't want to reduce the debt, what they'll ultimately do is call, and they'll just replace it with more debt. So again, all of that is a method of understanding how companies finance this long-term debt that they have. If we look at the yield of a bond or the required rate of a bond, it obviously has some components, right? So we're going to talk about some of these components as we go through the rest of this slide. The real risk-free rate, we have an inflation premium, maturity risk premium, default risk premium, and a liquidity premium. So we'll go down through each one of these and talk about them throughout the next video, or this video. So what is the real risk-free rate? This is, again, a rate that it's a hypothetical riskless security. We typically use short-term treasury securities. They refer to as Treasury Inflation Protected Securities, or TIPS, right? So this is debt of the United States government that has an inflation protection on it. So the only thing that you will see, if I go back a slide, right? It doesn't have really much maturity risk. It's a United States government security, so it has no default risk premium. It may have some liquidity premium, but in general, it's protected from this thing here, this inflation premium. So the T-bill, we assume, has none of this, but it does have inflation. So this is just a way of adjusting or having a proxy, if you will, for a risk-free security. So the nominal risk-free rate, again, we've just been talking about this. If you're talking about a short-term security, you want to use a T-bill. Longer-term securities, if we're making comparisons, you might want to use a T-bond. To estimate the inflation premium, then again, we use this, we can use Treasury Inflation Protected Securities. The IP for a particular maturity is the difference between the Treasury, the TIP, and a regular Treasury security. So as I mentioned, a regular Treasury security has inflation. It's the risk-free rate plus inflation. So a TIP just has risk-free. So if you take a Treasury bond, let's say we take a 20-year T-bond and a 20-year TIP. If you subtract the returns of those two, or the yields of those two, you will get an estimation of inflation. Next thing we're going to talk a little bit about is something referred to as a bond spread. A bond spread is the difference between bonds that have different characteristics, if you will, with respect to the default risk premium and the liquidity premium. So there's a difference, right? So you'll see, a 20-year bond might have a yield of 4%. A 10-year bond might have, I forgot what I just said there. So let me start this over. So I'll make the numbers easier to remember. So a 20-year bond is 10% and a 10-year bond is 5%. So the difference between them, that other 5%, is what we refer to as the spread. So large, strong companies, their risk levels are much lower, so they're going to have very small bond spreads. The smaller the company, the greater the amount of the spread will be between the different levels. So here we see investment grade bonds and junk bonds. I always refer to the S&P 500, but a AAA rated bond, how do they default? How frequently do they default? Well, with 1 year, less than 0.13% default, 0.68% within 5 years. CCC rated bonds, obviously referred to as junk bonds here, 21% of those will default in the first year, 35% within 5 years. Again, this is the default risk that we're talking about with respect to bonds. As you go down this rating system, as you can see, you get higher and higher rates of return or rates of bankruptcy or defaulting on these types of bonds. So what do the yields look like and the spreads? So if we have a AAA rated bond, has a yield of around 2.21%. The 10-year T-bond is 1.72. If you subtract those two, the spread is 0.49. So the spread on a CCC rated bond, it's going to earn roughly 8.37%, but it's also going to have a spread of 6.65% over the risk-free 10-year bond. And of course, you can also recognize there is a spread at each level. So we can say the spread between AA and AAA is 0.06. Right? That's the easiest math I can see to do there. So what factors affect the default risk of the company? There's many factors that affect it. The debt ratio, coverage ratios. These things obviously all come from the financial statements of the company. So we have interest charge coverage, the EBITDA coverage ratios, profitability ratios, current ratios. All of these ratios have impact on the default risk of the company, or at least giving us a picture of what potential default could be. So if we look at the percentages, if you will, right, a AAA rated bond averages are a return on capital, right, return on investment of around 27.6%, and the relationship of debt to capital is around 12.4%. As you go down the list, we find that in general returns go down, right? And the debt on capital, the ratio of debt, the leverage ratio goes up. So the picture of debt increases, right? The amount of debt increases, which means the return then also increases, this decreases. There are other facts, though. There are provisions in the bond contract, right? The sinking funds, whether there's one or not, is it secured, unsecured, maturity? All of these are factors that are in the contract that have an effect on bond ratings. Earning stability, the regulatory environment, accounting policy, all of these things are analyzed. Who does this analysis? The analysis is taken on by companies like Standard & Poor's, Fitch, Moody's, and there are some others that are a little bit lesser known. So again, that's our discussion of some calculation of value and some discussion of default risk. See you in the next video.